Our guest says the latest US jobs and inflation data have not provided clarity on the Fed's decision on interest rates. Heading into that big speech by Jay Powell tomorrow at the Jackson Hole gathering, our guest thinks a hold on interest rates is likely this month, with the next cut occurring at the Fed's final meeting of the year. We're joined by Blake Gwinn, head of US rate strategy at RBC Capital Markets. Blake, great to see you, and thanks very much for coming on the show. So you think really the Fed doesn't have enough data to justify a cut at this stage?
Yeah, I mean, I really attached to a quote we heard from Musalem, one of the Fed presidents, who said, we're missing right now on our inflation target. We're not missing on our labor target. So despite some of the concerns I think people have had about the labor market after these NFP revisions we got several weeks back, inflation seems to be the real problem right now. I mean, we clearly saw the tick up in PPI. We've seen, in CPI, really the breakdown is a little problematic, with services now not being the negative offset that I think many people had hoped to tariff-related goods inflation. So I just think there's a lot of questions around the inflation picture. And when you have both sides of the mandate pulling against each other, you don't really know which one's going to win out. It's very hard to act right now.
And the mandate being, on the one hand, keeping inflation under control, but on the other, supporting employment in the United States.
Correct. On the employment side, I will say, if you look across the spectrum of data we get, obviously there was a lot of focus on these NFP revisions, but I think the labor side is very tricky right now because we have some very big shifts that are going on in the supply of labor. A lot of that is the change in immigration policy, which obviously has some pretty meaningful impacts on labor supply. And the other is the aging of the population. We have a lot of retirements going on. That baby boomer generation is getting to retirement age. So there's a lot of people coming out of the workforce for both of those reasons. And we just don't know what that really does to the kind of break-even payroll level, if you will. So, when we get these numbers, we get these revisions and we see, 30, 35K type of average. Is that good or bad? We don't really have a lot of context for it. And I think that's why Powell said at the last press conference, he's going to be focused more on the unemployment rate. And that's the same as we're thinking as well. You have to look at the spectrum of data. And there we don't see, a major deterioration in labor.
I know this is a simplistic question for a rate strategist, but say you're having a beer with a buddy and they said to you, should I just buy 10-year bonds now and hold them to maturity? I know it depends on so much, but what do you think? Are US 10-year bonds looking like decent value?
Well, as a rate strategist, I have to make it more complicated. Are we talking about real or nominal? Do you want the inflation protection or not? Because I think if you look at real yields, those longer dated real yields protected from inflation, those actually look very attractive. Now, the one thing I will caveat this is that I think some of this escalation in pressure on the Fed, as the administration really seems to be attacking Fed independence, I keep waiting for this to be a more problematic issue for the long end of the curve, because I think when you start to challenge that independence of the central bank, markets should kind of punish that with a sell-off in the long end. So I'm still waiting for some of this escalation, not just the attacks on Powell, but now being escalated to the issues that came up with Cook over the last few days. When did the market start saying this is a problem for long-run inflation stability, and see those kind of longer-end yields start to rise?
So, I mean, I think some people might say, well, it seems a bit wonky. Does it really matter who's heading the Fed? But is it a big deal?
Look, I think what is a bigger deal is not necessarily who's heading the Fed per se, but really that, the Trump administration is making it pretty clear that they're going to use every angle, every loophole, every document that any Fed official has ever, signed. They're going to be going through this stuff, and they're going to find ways to try to leverage it to get what they want, which is rate cuts. So, I think this really serves as a reminder. To me, it's less about what Cook did or didn't do. It's really just a reminder to the rest of the board, and even the Fed presidents who, aren't appointed by the president, the regional bank presidents. They're not appointed by the president, but it's a reminder to all of them that, I think, hey, we can still get to you. So this is definitely meaningful. And, even if who's actually in charge at any given time, I put less emphasis on that. But the broader attacks against the independents are certainly worth watching and could be market moving.
You were talking there about the top Fed official, Lisa Cook, who's come under fire from President Trump. There's been apparently allegations of mortgage fraud. Nothing proved, I think.
Correct. This is just, Twitter is not a court of law.
Right.
But, obviously we've had Pulte at the FHFA kind of lodging some accusations against Cook. But like I said, it's less to me about the details of this particular allegation or, what Cook did or didn't do. It's really a shot across the bow of the Fed by the Trump administration that says, hey, we can still get to you guys if you don't give us what we want and don't listen to us and kind of obey what we're asking for. So that to me is the more interesting issue. And I think where I really separate a bit is that I don't really see this manifesting in near-term cuts. And this kind of gets to your question about, does the Fed share matter? I don't see this as a reason to price in cuts for the rest of this year or even early next year. But what I do see is that breakdown of the wall between the central bank and the administration on a long run basis, that does call into question, this very well anchored long run inflation expectations that we've had in the U.S. for quite some time.
Yeah, we should note that the Trump administration is also pursuing mortgage fraud investigations against Senator Adam Schiff and also the New York Attorney General. So we won't get bogged down on that. So yeah. I'm trying to think, what about laddered bonds? Sometimes we get financial advisors on and they think, well, laddered bonds, you're covering your bases. Is that a good idea with a bond portfolio these days?
I mean, I don't get into as much the personal recommendations for some of the financial products for retail. But I will say it's a tough environment right now because you asked about the 10-year earlier. I'm worried about these risks around Fed independence. But if our economic and our Fed call comes to fruition, it probably should mean lower yields, a flatter curve, at least in the near term. And then as we get into next year, when things do start to weaken a little bit more, as we expect, the Fed actually does engage on a course of cutting back to kind of a 3% neutral rate. Our view is that should push yields down. It should flatten the curve initially and then start to steepen it back up again. All of this is very range bound. The thing that I highlight around this independence is really kind of the tail risk towards a bigger bear steepening or a steepening of the curve that's driven by long end yields moving higher. That's a risk that really I'm just starting to worry a bit more about as these attacks have kind of escalated.
Thank you very much. I really appreciate it, Blake.
Sure.
Blake Gwinn, head of U.S. rate strategy at RBC Capital Markets.